Hello and welcome to the show. I'm Kim Parlee. It is great to have you with us tonight. Well, assets held in passive investment funds, things like ETFs, other instruments that track a market-weighted index, have more than doubled in the past 4 years. The sector now accounts for $1.3 trillion of U.S. investors' assets, as numerous investors are favoring these types of low-cost passive investments over actively managed funds. But my next guest says that reports of the death of active management have been greatly exaggerated. Joining me from New York is Bill Priest. He is Chief Executive Officer, Co-Chief Investment Officer of Epoch Investment Partners with over $42 billion in assets under management. Also the author of the book you're seeing on the screen called Winning at Active Management, The Essential Roles of Culture, Philosophy, and Technology. Bill, it is great to have you with us.
It's a pleasure to be with you, Kim.
Let's start things off. I should let people know we've got a few things we want to accomplish in our conversation. We want to hear about the book in my hand, and I want to hear about why you wrote it. Also want to talk a bit about just what's happening in the markets right now and what metrics, as you like to tell us, you're focused on. Why did you write this book? Why Winning at Active Management? Why is the time to write this right now?
Well, it's essentially a second installment from a book we wrote a few years ago called on free cash flow investing, new priorities for the global investor. But I wanted to write this because it's timely, and secondly, I think over my many years in this business, we wanted to focus upon the essential elements that's required to be a successful asset management firm. So we really wanted to go into what is required to create and perpetuate successful asset management firm.
Okay. Well, what is necessary to make it happen?
Well, I think there are three prisms through which you should look at an asset management firm. One has to do with its culture. What is the culture of this firm? What is the community it's trying to serve, and how well does it serve it? Secondly, what is the philosophy, the investment philosophy that understands what this firm is trying to do? Is it transparent? Is it understandable? Does it have architectural integrity? That's the second piece. And the third piece is the use of technology. Some people would call it quantitative investing, but technology is really quite important. You want to infuse technology into the investing process itself. And so the book is really divided into three parts. We spend a lot of time discussing the role of culture. What is the structure that will likely maximize the success? Is it a command and control structure or more of a partnership structure? And we come down pretty noticeably on the side of a partnership structure, but the way to think about it's a little bit about SEAL Team 6 in the U.S. Army. You can't run the U.S. Army except through a command and control structure, but SEAL Team 6 requires a partnership structure. They can coexist inside a single entity, and we go into, in some detail, how we think that culture has to perpetuate itself and what you need to be successful, which includes hiring. And there are three constituencies you're serving. You're serving, number one, your clients, because that is the number one element of any culture. Your constituency is your client. If they don't win, not only will you lose, you don't even deserve to win. The client has to win. You've got employees and you've got the owners of the business. But number one is to focus on the client winning from a cultural standpoint. Then we go into, and you and I have had these conversations before, is where is the source of value in a corporation? It really comes from the ability to grow and manage and allocate cash flow, essentially free cash flow. And we spend a lot of time in that section on the very question you raised, active versus passive. And finally, the third part, we go into how technology is going to become an increasing necessity to survive in asset management. And then we talk about how we use it as well.
Let me just dive into one of those pieces here. Active versus passive has been debated by people much smarter than me for, I want to say, half a century. I mean, it's been a long time. How do you tackle this? I mean, a lot of people I've talked to have said passive has done so well because it's more accessible than it ever used to be. I mean, you could access to different kinds of securities. Technology makes it quick. And we've also got a market with quantitative easing where things seem to be highly correlated. So has that fueled the passive side along?
Well, you raise a good question, and you isolate two very important points. Believe it or not, probably the first speech given on passive investment was done by Ben Graham in 1963, which is a long time ago, where he raised the idea of owning a portfolio rather than a set of individual securities. Now, this actually preceded the index fund rage. If you fast forward to today, I think the argument is both are going to exist. And here's essentially the reason why. If the world was 100% active, it is actually the perfect time to launch a passive index fund, because in an all-active world, the pursuit of mispricings in the marketplace have pretty much been arbitraged away as much as possible. And you can essentially get a free ride from all the active managers by owning a passive index fund. But the other side is true as well. If the world is 100% passive, in any passive index fund, you own the good stuff and you own the bad stuff. If it's all passive, you now open up a marketplace where there's real opportunity to profit from what are mispricings of securities. So you're going to wind up with both. Right now, you've got a flow leading to where there's more heading to passive than active. But the point you raise, and it has to do with the regimes of investing, and are there one or two variables that explain the tremendous rise in the stock market? And you're absolutely right. From our view, quantitative easing and the artificial lowering of discount rates on financial securities have been absolutely amazing. And just to give you a statistic, which I think you may even be bringing up in a chart a little later, but if you were to look at the MSCI index for the last 4.5 years, there have been virtually no earnings gains. The index is up something in the order of 55 to 60%, and 80% of that rise has come from PE expansion, which is almost completely attributable to the collapse in interest rates. So I think you raise a point. It has been the fuel for much passive investing, but there's a place for passive investing in the world.
It's fascinating. I'm glad we had the whole show for this, because I was speaking with John Malden last week, and it was funny. The one thing I asked him to isolate about with a hot trend for him would be active management. He said that's where people have to hang their hat over the next little while. So I'm sure you both had lots to talk about. Technology, you mentioned here as well that that's something we need to watch very closely. And you coined something here, racing with the machine. Tell me a bit what you mean by that and where that came from.
Well, it actually started a few years ago from a book by two authors, Brynjolfsson and McAfee. They both are at MIT. They've written two books. The first one was called Race Against the Machine, and this, in a sense, is a play on words, racing with the machine. A more recent book, which I think your listeners might want to look at, is something called The Second Machine Age. And what's critical there is how they point out what's happened with technology. There have been three basic trends that have happened to allow technology to play this very important role. It first starts with Moore's Law. Moore's Law basically says the power of a computer chip per dollar doubles about every 18 to 24 months. Well, we've had something like 35 doubles since that came out in 1965. And through that doubling of the power of the chip, it's led to the digitization of just about everything. We have digitized music. We have digitized every piece of data we can think of, and it's all in the cloud. And the ability to recombine the data in the cloud through algorithms is unbelievably powerful. So in an investing world, when you're dealing with millions and millions of bits of information, the ability to recombine that into informative algorithms is really quite helpful. You need to be able to cast a wide net over all of the data. There's no other way to do it except through technology. The key is technology will allow you to collect the dots, but human beings are required to connect the dots. So it's going to be a fusion of the ability to collect with those who can judge and connect.
All right, that is a start of our conversation with Bill Priest. He is Chief Executive Officer and Co-Chief Investment Officer of Epoch Investment Management. When we come back, we're going to delve further into some of the things that are happening today. We're going to be talking about Brexit. You're watching Money Talk. Please don't go anywhere. Welcome back. We're here again with Bill Priest, CEO and co-CIO of Epoch Investment Partners. He joins us from New York, also co-author of Winning at Active Management, holding it up here on the screen so everyone can see it. And again, this is a new book just out there. And as Bill just told us, fascinating topics he's talking about. Bill, we've got you here. I want to talk to you a bit about what's happening in terms of the headlines, what's going on. Brexit. I haven't spoken to you since this has happened. So your take on what this means for the markets.
Well, the way to think of Brexit is to think of contagion. And I think investors should be concerned with three kinds of contagion. There's financial contagion, there's economic contagion, and there's political contagion. Now, financial contagion is pretty much what we experienced in 2008 with the global financial crisis. That was a financial crisis that came upon quite suddenly, and it had tremendous ramifications all over the world. It was a giant liquidity crisis that turned into an insolvency crisis and ultimately the global recession. The way to fix it was to flood the system with money. The central banks did that, and frankly, I think they saved the world from a catastrophe. There is no financial contagion associated with Brexit. Nothing at all. We have nothing to worry about there. The economic contagion has to do with, will there be a slowdown as a result of their exit? Will there be, with respect to the United States, it's virtually zero. We should see almost nothing from the position of the U.S. or, for that matter, Canada. When we look at it from the European side, there may be a little bit, there may be a modest slowdown from Brexit in the short term. We don't see a great deal of effect. Britain itself may very well have a recession starting sometime next year. I think it'll be mild, and we don't really worry much about it. It's the political contagion that is the concern.
And Bill, we've got the chart up.
Contagion,
sorry to interrupt. I just want to tell people we've got this chart up here. We've got financial, economic, and the political in the upper right-hand quadrant. So please continue. What's the danger of political contagion here?
Well, the political contagion has to do with the fact that no matter who you talk to before that vote, virtually everyone we consulted, every academic, there was almost no one that predicted a leave win versus a remain win. And in fact, some of us were able to talk to very senior people in Britain, both in Parliament and in the government, and by 100%, the idea was 55-45 remain. And yet it came out 52-48 leave. I think it speaks to a bigger problem. It speaks to the rise of populism. We can see it in our political system in the U.S. We can see it in Europe. This is an era where we're going to have to confront the dissatisfaction from a large number of individuals who have not benefited from the substantial recovery in the stock market. So the political contagion, specifically with Europe, is there are a lot of populist parties that would like to have a say in a vote on whether they want to stay in the EU or not. I think that's going to be more talk than action, but you're going to hear a lot of it, both from Italy, which is already front and center, and you're also going to hear about it in France and the Netherlands as well. So there's going to be a lot of noise, and there may be some political repercussions from this that we haven't been able to witness yet.
I don't want to hijack this conversation, but the one thing that when you were talking that I kept thinking was, we couldn't rely on the pollsters or even people who had money betting on the outcome of Brexit. If we can't rely on those, and even the people that seem very informed, what does that mean for the U.S. election and what's actually happening there? I mean, that has a much larger impact on what could happen with the markets.
Well, the U.S. election is challenging, to say the least. I think you've had two extreme points of view, one from the right, as represented by the Republican candidate Donald Trump, and actually one from the left, as represented by Bernie Sanders. We don't really have a central figure per se, and I think Hillary will do her best to kind of take that center. The way in which this election is being held is almost a shambles for basically good behavior. We have reality TV now embedded in the U.S. political system. I hope at some point our Constitution is strong enough to manage certain limitations that will be required on anyone who is elected, whether it's Hillary or Donald Trump.
Well, I'll have to have you back for a much longer conversation on that. All right, stay with us, everybody. When we come back, again, more with Bill Priest. We're going to be talking about his economic outlook from an asset allocation, what people should be thinking about. You're watching Money Talk. Please don't go anywhere. All right, welcome back. Well, Epoch Investment Partners puts out some fairly regular data to, and I should say intelligence to investors in terms of what they're watching in the world and what they think is going to be dictating where the markets is going. We've managed to grab some of that to share with you, and we've got, of course, Bill Priest, the CEO and co-chief investment officer, to explain some of these boards. Bill, we've picked a few here, and I will let you know what's coming up first. The first one is 2%. Is the new 4% for mature economies, and yes, that's a bit depressing.
Well, let's take a look at what that chart says. Real GDP is composed of only two fundamental elements: growth in the workforce and growth in productivity. So the sum of those numbers will always equal real GDP. So when you look at the developed world, and here we show the U.S., Europe, and Japan, the U.S. is the only developed country of size that's actually seeing a substantial growth in its workforce, and it's quite positive, and it's going to continue. On the other hand, Japan and Europe, you're going to have very little.
You were
now when you
go ahead,
when you look at the sum of the columns, what you will find is 2% is the 2% is going to be the real growth in GDP, and inflation is almost non-existent. The one positive here, though, is that productivity is not measured properly. Productivity in the U.S. is running close to zero. It's actually much better than that. We really don't have a way to explain unmeasured productivity, and that is from technology, the internet, and so forth. So when we look at real GDP, 2% is pretty good. 2% is the real GDP. Inflation is modest. So the world is growing, but one should not expect it to ever come back to 4 to 5%. The demographics and productivity measures just won't allow that.
You know,
but it'll still be fine for equity investors.
It's amazing when you say about productivity not being measured properly. When you hear news today that Facebook has 1.7 billion users, I mean, that's a form of productivity, maybe not in the traditional sense, but you know that it's adding, to the economy in different ways. We brought up a chart up there just briefly, and I want to bring it back up. It's the one you mentioned earlier about what's been driving equities and how much of this outsized equity gains have come from QE. This is an incredible looking chart.
Well, let me elaborate on that chart a little bit. On the lower left-hand side, back in 2012, the market sold at about 12 times forecasted earnings for the S&P 500. And when we look at where it is today, we are selling at about 18.5 times earnings. So we've had a 50% increase in PE ratios over this period of time. And frankly, not much growth in earnings for the MSCI. In the U.S., we've certainly had some earnings growth. But this chart has largely been driven by a single variable, and that's quantitative easing and the effect that it's had on very, very low discount rates. If you were to combine the impact of quantitative easing and the seeking of yield, those two variables explain most of the gain in stocks over the last 4.5 years. So any strategy that was willing to bet on rising PEs and earnings, or on, dividends, that has done extremely well. So normally, it's more than one or two variables that are going to explain the market, and I think that's one of the forces that have been led to the positive contributions into passive ETFs and indexing as well. It will continue until it doesn't work anymore. But active management, I think, will have a place to play as this unfolds.
Yeah, and there's a look at the chart we have here.
Okay.
Yeah.
So here, if you look at the chart on the right, and this basically takes you from the beginning of 2012 through the middle of this year. So we're talking 4.5 years. Essentially, the MSCI, which is one measure for the world index, is up 70 percentage points. But 57.6 of that is multiple expansion. Earnings were virtually zero over that period of time. It just illustrates how powerful QE has been to the valuation of earnings and dividends.
Bill, I've only got a couple of minutes left here, but there's one chart I wanted to bring up because despite all this, I mean, despite the fact that we've seen, equities have seen that PE expansion, they've done what they've done. If we take a look at an asset allocation chart you have here, you're still showing that equities offer better returns over sovereign bonds, which again is it's ugly because we have some with negative yields. But how much? I mean, where are those equity returns going to come from? I mean, do you still expect more PE expansion from QE? I mean, what more can central banks do?
Well, we have been surprised that you've even seen the recent expansion in multiples. Our view had been if you took the dividend yield, and we define dividend yields as the cash dividend yield plus net share buybacks, and that number is probably running 3 to 4%, and there's a growth rate associated with that. So if you have basically what we call a shareholder yield of 3 or 4% and a growth rate, let's say, of 3, that's a very attractive investment vis-a-vis a sovereign bond. That said, the returns from bonds since the beginning of the year have actually been better than stocks. But we feel that's likely coming to an end. But there is growth in the real economy. If there's growth in the real economy, you'll have some growth in earnings. If payout ratios are the same, you'll have a growth in dividends. So our feeling is that if you are willing to live with the volatility of stocks, which means your holding period has to be measured in years, 3, 4, 5 years, it's hands down more attractive to own equities than bonds, particularly sovereign bonds. Many buyers of sovereign bonds are not investors per se. They're institutions that have to own them. And we have a number of negative investment, negative interest rate countries in the world. You hear more and more right now about helicopter money and policies that will continue to spur lower rates because the powers that be are just terrified with respect to deflation, and they will do anything to prevent it. So I think there's an assumption in the marketplace that there is this put that the central bank has placed out there, and I believe it's there. I don't know if it's going to last, but you can see it.
Bill Priest, I would love to keep talking, but we have to go. Thank you so much. Bill Priest, CEO and Co-Chief Investment Officer of Epoch Partners. He joined us from New York, author of Winning at Active Management.